In 1927, a physicist named Werner Heisenberg discovered something that shattered how we understood reality itself. He proved that you cannot simultaneously know both the exact position and the exact momentum of a particle. Not because our instruments aren't good enough, not because we haven't invented the right technology yet. It's a fundamental limit baked into the structure of the universe. The more precisely you pin down where something is, the less precisely you can know where it's going. Now here's a strange thing that happens every single day, in every market, all over the world. The more precisely someone tries to pin down exactly when to buy and exactly when to sell, the more confident, the more certain, the more precise their timing call, the more likely they are to be catastrophically wrong. That's not a coincidence born from bad luck. It's something closer to a structural law of how markets behave. And by the end of this video, you're going to understand exactly why trying to time the market isn't just difficult. It might be something closer to fundamentally, structurally impossible, for reasons that echo, in a genuinely useful way, the same uncertainty that Heisenberg found sitting at the bottom of physical reality itself. Let's get into it. Before we go any further, let's be precise about what kind of claim this actually is, because that word physics, in this video's title, deserves the same careful handling we've given it every other time on this channel. Heisenberg's uncertainty principle is a real, rigorously proven law of quantum mechanics. It applies to subatomic particles, electrons, photons, governed by the literal mathematics of quantum physics. Markets are not quantum systems. Stock prices are not electrons. Nobody has proven that markets obey the uncertainty principle in the strict, mathematical sense that physicists mean when they use that phrase. So let's be honest. Calling market timing impossible because of the uncertainty principle is a metaphor, not a literal application of quantum physics. But here's why it's a genuinely useful metaphor, rather than empty wordplay. The core structural insight underneath Heisenberg's discovery, that the act of measuring a system can fundamentally disturb the very thing you're trying to measure, maps remarkably well onto something real and well documented about financial markets. Not because markets are quantum systems, but because markets share a specific, structural feature with quantum systems. The observer isn't separate from what's being observed. And once you see that parallel clearly, an enormous number of genuinely strange, well-documented market behaviors suddenly make a lot more sense. Let's start with the single strangest, most well-documented pattern in this entire topic. The market seems to specifically punish confidence. Research consistently shows that the more convinced people are about a forecast, the more likely they are to be wrong. And there's a specific mechanism behind why this happens. Not just bad luck evenly distributed across confident and uncertain predictions. Confidence about a market move tends to rise precisely as that move is already becoming widely known, which means, by the time a forecast feels obvious and certain enough for someone to act on it decisively, the move it's describing has frequently already been priced in by everyone else who noticed the same pattern slightly earlier. Certainty, in other words, often arrives late. By the time you feel sure enough to act, the market has usually already moved past the opportunity that made you feel sure in the first place. Here's a structural problem with market timing that almost nobody accounts for when they first consider trying it. Successfully timing the market doesn't just require one correct decision, it requires two. You need to correctly predict when to exit, getting out before a decline. And then, separately, you need to correctly predict when to re-enter, getting back in before the recovery. Two independent decisions, each with its own odds of being wrong, multiplied together. And here's the part that trips up even disciplined, careful investors. The second decision is usually harder than the first. Deciding to sell during a scary decline feels emotionally justified. Fear is doing a lot of the work for you. But deciding to buy back in requires overcoming a completely different emotional obstacle. Buying into a market that's already recovering, that already feels like it got away from you. That requires admitting your exit might have been premature. Most market timing strategies fail not on the exit. They fail on the much harder, much more psychologically uncomfortable re-entry. Now let's get to the specific piece of this puzzle that connects most directly back to Heisenberg's actual physics. The part of this metaphor that's doing real intellectual work, not just borrowed vocabulary. In physics, the uncertainty principle describes a genuine trade-off between position and momentum. The more precisely you know where a particle is right now, the less precisely you can know where it's heading. There's a loosely analogous trade-off in how traders actually look at markets. The more intensely you focus on a security's exact current price, watching every tick, every microscopic fluctuation, the harder it becomes to perceive the broader underlying trend clearly. And the more you focus on the broader trend, the less precisely you can pin down the exact right moment to act on any single price. This isn't a proven mathematical law the way Heisenberg's principle is. It's closer to an observed pattern in how attention and perception work when applied to markets. But it's a genuinely useful way to understand why so many technically skilled traders, who can read a chart with real precision, still struggle to consistently translate that precision into timing decisions that actually work. Here's a pattern that should reshape how you think about every piece of financial news you've ever reacted to. Markets, for the most part, don't react to events themselves. They react to expectations about those events, which means that by the time news becomes obvious and widely reported, the price has frequently already moved to reflect it. Waiting to react to confirmed news rather than anticipated news feels intelligent and cautious in the moment. It's frequently just too late. This connects directly to something we explored in our video on market crashes. Markets are reflexive systems. People don't just observe prices, they react to prices, and their reactions become new information that other participants then react to in turn. By the time a piece of information is certain and confirmed enough for the average investor to feel comfortable acting on it, that certainty has typically already been absorbed and priced in by everyone who moved earlier, while it was still uncertain. Here's the single most consequential fact in this entire video, and it deserves to be understood in real, concrete detail rather than just mentioned in passing. Historically, many of the market's best-performing days cluster extremely close to its worst-performing days. The moment of maximum fear, the day everything looks the most broken, the most hopeless, is frequently followed within a very short window by some of the sharpest recoveries in market history. This isn't a loose generalization. It's a repeatedly documented pattern across market timing studies, and it creates a genuinely brutal trap. Trying to avoid the pain of the worst days by pulling out of the market means you're statistically very likely to also miss the best days, because they tend to sit right next to each other on the calendar. Studies examining this pattern consistently find the same result. Investors who miss just a handful of the market's single best days, sometimes fewer than 10 trading days, spread across multiple decades, see their long-term returns collapse dramatically compared to investors who simply stayed invested through everything, the good days and the bad days both. The pain of the worst days and the reward of the best days aren't separate events you can cleanly choose between. They're frequently the same event, viewed from before and after. Here's a pattern that should make you deeply skeptical of any short-term prediction you hear, no matter how confidently it's delivered. Daily and weekly market movements contain an enormous amount of statistical randomness. Even when genuinely useful, accurate information exists somewhere inside a short-term price movement, it's frequently buried underneath so much unrelated noise that extracting the real signal from the surrounding randomness becomes practically impossible in real time. This is exactly the same structural problem we explored in our video on market crashes and criticality. Markets are complex systems with an enormous number of small, interacting variables, and short time horizons simply don't provide enough data to reliably separate genuine signal from pure statistical noise. Zoom out far enough, and patterns become clearer. Zoom into the time frame that actually matters for day-to-day trading decisions, and you're mostly looking at noise wearing the costume of a meaningful signal. Here's where the physics parallel gets genuinely sharp, rather than just loosely poetic. When a market forecast becomes popular enough, traders begin adjusting their positions in anticipation of that forecast coming true, which can actively invalidate the very prediction everyone is now chasing. If enough people believe a stock is about to rise and buy in anticipation, that buying pressure itself can cause the price to rise immediately, using up the very move the original forecast was trying to predict, before the underlying reason for that forecast has even fully played out. This is the closest genuine parallel to quantum measurement disturbing a system in this entire video. The act of observing and acting on a prediction changes the market being predicted in a way that's structurally similar, not identical, but structurally similar to how measuring a quantum particle's position disturbs its momentum. The observer isn't outside the system in either case. The observer is part of the system. Here's a detail that undercuts a huge amount of confident-sounding financial commentary. Two skilled analysts can look at the exact same chart, the exact same data, and walk away with completely opposite conclusions about what happens next. This isn't a sign that one of them is simply bad at their job. It's a reflection of something deeper. Markets are shaped as much by interpretation as by raw observation. The data alone doesn't determine the future. How different participants interpret that data, and how they act on their interpretation, becomes part of what actually creates the future outcome. Here's the emotional mechanism sitting underneath almost every other pattern in this video. Investors are statistically far more likely to sell after a decline has already happened, and far more likely to buy after a rally has already happened. That's the exact opposite of the disciplined, buy low, sell high, behavior that successful timing would actually require. Fear peaks after the damage is already done. Greed peaks after the gains are already made. Human emotional timing is, systematically and predictably, running backward relative to what would actually work. Here's a cost that almost nobody properly accounts for, precisely because it never shows up as an actual loss on a statement. Sitting in cash, waiting for a safer moment to invest, feels responsible. It feels like you're avoiding risk. But if the market's recovery begins while you're still waiting on the sidelines, the opportunity cost of that waiting can dwarf whatever downside you successfully avoided by stepping out in the first place. This cost is genuinely invisible in the moment. Nothing on your account statement labels it money you didn't make because you were too cautious. But it's frequently the single largest cost in the entire market timing equation, hiding in plain sight precisely because it never appears as a visible loss. Let's bring in a story you already know from this channel, because it belongs directly in this conversation too. If institutions with enormous research teams, sophisticated models, and vastly more resources than any individual investor consistently struggle to sustain a reliable timing edge, the odds are stacked heavily against an average investor trying to outguess the market casually. Remember long-term capital management, the hedge fund from our Black Skulls video. It was staffed with some of the most brilliant financial minds of its era, genuinely Nobel-level intelligence, sophisticated modeling, immense resources. And it still collapsed catastrophically in 1998. That's not a story about incompetence. It's a story about the market punishing certainty and precision, regardless of how brilliant the people holding that certainty happen to be. If LTCM's brilliance couldn't reliably beat this problem, that should tell you something important about how structural, not just personal, this challenge actually is. Here's a reason timing strategies that seem to work eventually stop working. Markets function as complex adaptive systems. They change their own behavior as participants learn and adjust. A pattern that reliably worked yesterday attracts attention today, and once enough people notice it and start trading on it, that same crowd behavior tends to destroy the very pattern they're now chasing. Yesterday's winning strategy becomes today's crowded, arbitraged-away trade. Here's the direct, mechanical consequence of markets adapting this way. If a genuinely profitable trading opportunity becomes obvious enough for many people to notice, capital rushes toward it collectively, and the edge that made it profitable in the first place gets competed away, arbitraged out of existence, often much faster than the people chasing it expect. The more visible and well-known a market inefficiency becomes, the shorter its useful lifespan tends to be, almost by definition. Being right about a pattern and being early to it are two completely different skills, and only one of them actually pays off. Here's a pattern worth watching for the next time you encounter confident-sounding financial commentary. A highly detailed, extremely precise-sounding forecast can sound impressively intelligent, while actually being considerably less useful than a broader, honestly probabilistic view of risk and potential outcomes. Precision creates an illusion of expertise. A forecaster who says the S&P will close at exactly 5,847 by March 14th sounds far more confident and informed than one who says there's meaningful uncertainty here and outcomes could reasonably range widely. But the vague, honest answer is very frequently the more accurate one. It's just far less satisfying to listen to and far less likely to get repeated and shared. Let's tell one of the best stories in all of investing folklore, because it makes every point in this video land at once. There's a famous, widely cited example sometimes nicknamed the world's worst market timer. An investor, often referred to as Bob, who had spectacularly, comically bad timing luck. Every single time Bob had money saved to invest, he happened to invest it at a market peak, right before a downturn, over and over again, across decades, with almost supernatural bad luck. And Bob still ended up a millionaire. Not because his timing was secretly good. His timing was, by design in this thought experiment, genuinely the worst imaginable. He became wealthy anyway, simply because he stayed invested, consistently, through every single downturn that followed his terrible entry points, and let the market's long-term growth do the work regardless of when he got in. Bob's story isn't really about timing at all. It's about what happens when you remove timing from the equation entirely, and simply let time itself do the heavy lifting. Here's the reframe this entire video has been building toward. The actual, durable edge in long-term investing isn't precision timing. It's survival, staying invested, managing risk sensibly, and specifically avoiding getting forced out of the market by volatility at exactly the wrong moment. Long-term wealth accumulation has consistently rewarded people who simply remained in the game, far more reliably than it has rewarded people who tried to cleverly dodge in and out of it. Here's a genuinely uncomfortable statistic worth sitting with before we close. Studies examining the track records of well-known financial forecasters have found that a majority were accurate less than half the time, meaning a significant number of widely followed, confidently delivered predictions performed worse than a simple coin flip would have. Popularity and media visibility are not the same thing as actual predictive skill. People consistently gravitate toward confident, precise-sounding forecasts, not because those forecasts are more accurate, but because confidence itself is psychologically satisfying to listen to. The exact same pattern we opened this video with, showing up again at the level of the professional forecasting industry itself. So here's the clean, honest sentence I want you to actually walk away with today. The market cannot be reliably timed, because every serious attempt to measure and act on it changes the very conditions being measured. That's a metaphor, not literal physics. We established that clearly at the start of this video, and it's worth repeating honestly here at the end. But it's a genuinely powerful metaphor because it correctly identifies something real. The observer and the observed aren't cleanly separable in markets, any more than they are in quantum mechanics. Certainty tends to arrive late. Precision often disguises unreliability. And the specific psychological traits that make someone feel confident enough to attempt precise timing are frequently the exact same traits that make that timing unreliable in the first place. If you've been with this channel for a while, this pattern should feel familiar by now. The reflexivity we explored here, prediction changing the thing being predicted, is the same reflexive mechanism from our crash video, where synchronized behavior among traders can create the very cascade everyone's individually trying to avoid. And the emotional mismatch between what feels safe and what actually works echoes the same brain versus math gap we explored in our compound interest video. Different topic. Same underlying thesis this channel keeps returning to again and again. Human intuition and market reality are frequently running in opposite directions, and the gap between them is where most of the real money quietly gets lost. Heisenberg never studied stock charts, but the structural insight underneath his discovery, that measuring a system can fundamentally disturb the very thing you're trying to measure, describes something genuinely real about markets too. Not because markets are quantum systems, because certainty, in both physics and finance, has a strange habit of arriving exactly when it's least reliable. The biggest loser in market timing usually isn't the market. It's the investor who waited too long, felt too certain, and got back in one moment too late. If this kind of thinking, where physics quietly explains the parts of finance nobody else is willing to explain, is why you're here, subscribe. New videos every week, breaking down the hidden math behind money. See you in the next one.